I'm Howie Lim. This is Money Hacks by the Business Times.
There has to be some kind of trade-off. There's no question about that. And you can quantify this. Take your $7 coffee and you really enjoy this coffee. You love to have it every day. That's fine. Recognize that $7 times 7 days a week times 52 weeks a year, that all adds up.
From budgeting to investing, the landscape of financial management can seem overwhelming. And in the world of personal finance, taking the first step can often be the most difficult. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch. btpodcasts@sph.com.sg. And we've got insights from Steve Foerster, Professor of Finance at Ivey Business School. His latest book is Trailblazers, Heroes and Crooks, Stories to Make You a Smarter Investor. And he reckons there are 3 levers to financial success. Use them and you're golden.
The idea is that we always face trade-offs when we are trying to achieve our goals. And specifically, we're looking at risk and return trade-offs. And investing is really all about trying to achieve the highest level of expected return for a given level of risk. And you're in control of those trade-offs. How you make those trade-offs to achieve your goals really depends on a sound investment philosophy. And my recent book provides some stories that should help you to develop a sound investment philosophy. It's really what your beliefs are. For example, do you believe you can easily outperform, let's say, a broad market index, or is it tough to beat the market? Are you confident, or perhaps are you overconfident in terms of your investing skills? What's your overall approach to investing? And for many investors, novice and professionals, sometimes you don't give it a lot of thought, and yet it really matters. So it's important to have some kind of evidence-based philosophy that can help you better attain your financial goals.
According to a recent Charles Schwab Modern Wealth Survey, the average Gen Zer starts investing at age 19. Whoa, this is younger than previous generations. It's 25 for millennials, 32 for Gen X, not true, not for this one anyway, and 35 for baby boomers. But what Steve is saying sounds like this might work for any financial goal, for any age, be it wanting to be a millionaire or just living well and taking care of loved ones.
Yes, absolutely. This would apply to any goals that you can quantify. And that's really the key. So you really start with what is it you want to achieve in life, and when do you want to achieve various milestones in life? And it could be planning for retirement. It could be some kind of house purchase. It could be saving for children's education. And you might need some help to do this. Perhaps a financial advisor can help you guide through this. So back to these levers, there's really only 3 levers that we have. And those levers, simply put, are how much we choose to save and invest on a regular basis, how long we will be saving and investing, and what kind of return we expect to get through our savings and investing.
Sounds like a plan. Talk us through the 3 levers, if you please. Number 1 being how much we save and invest.
So obviously, with how much we save, the more we save, the better position we'll be in terms of achieving these financial goals. And that's a decision we need to make that will involve some trade-offs, because really we're trading off consuming today, buying things that we enjoy now versus consuming later on, for example, in our retirement. So that's a trade-off that we have to make and try to balance that. In terms of how long we save and invest, if you ask me when's the best time to start saving and investing, I would always tell you yesterday was the best time. And the second best time is today, that you want to have as long of a runway as you can. Obviously, the more that you invest, the better position that you're in.
Got it. Number 1, how much we save and invest. Number 2, how long we save and invest. So what's number 3?
And so really that leads to this last lever that you have, depending on, again, imagine what those goals are, and we've turned them into financial goals. how much you are investing on a regular basis, say every year or every month perhaps, and how long you have, then it's a matter of what kind of expected return you will get relative to the amount of risk that you take. So on one extreme, the more you invest, the longer you invest, then you'll find that the expected return that you need to obtain those goals will be lower than if you invested and saved less or didn't save and invest for as long a period. So this is where you don't want to back yourself into a corner where it comes down to a very high expected return required to achieve your goals. The only way that you could possibly do that would be to take on more risk. And so that's a trade-off. The more you've saved and invested, the less risk you're going to take on. And when I talk about expected return and risk, so then that gets back to what kind of actual investments you're going to need to make, and stocks and bonds as usually the bedrock of what that's going to be.
Who's thinking sacrifice and needing to live an austere life? Okay, I'm putting my hand down now and taking that last swig of my fancy coffee. More with finance professor Steve Foerster on the 3 levers to financial success in a moment.
BT Correspondence welcomes Transport BT, the newest member in the channel's lineup, providing in-depth commentary and a 360 view on all things transport. Join correspondent Darren Wong as he explores the business of the sector and the policies that govern it. Hear from the industry leaders who will join him to provide context and insight. BT Correspondence, a new episode every Tuesday, wherever you listen to podcasts. Subscribe and listen today to BT Correspondence.
And now, back to Money Hacks from the Business Times.
The 3 levers to financial success: how much we save and invest, how long we save and invest, and what returns we expect. We're speaking with Steve Foerster, professor of finance at Ivey Business School. All I'm hearing, though, is sacrifice, sacrifice, sacrifice. Does it have to be this way? I said goodbye to my $7 coffee already.
There has to be some kind of trade-off. There's no question about that. And you can quantify this. So to take your $7 coffee and you really enjoy this coffee, you love to have it every day, that's fine. Recognize that $7 times 7 days a week times 52 weeks a year, that all adds up. And you can even quantify, if you weren't having that coffee, what might that amount of money compound to 15, 20 years from now? You might be surprised at how substantial that is. So the trade-off is your enjoyment for that versus how much potentially better off you would be down the road. So, but that's up to you to make that decision. Maybe it means you could have a lifetime of this delicious coffee, and perhaps you have to work an extra 3 months, an extra 6 months of your life in order to have that trade-off balance out. So that's up to you, and it's not for me to say you should do this, you shouldn't do that. It's just recognizing the trade-offs.
That sounds fair. But if you're not in a position to earn more by way of income, the job won't let you freelance, or you just don't have the energy to hustle on the side, there are other options, according to Steve.
You focused on the earning more portion. There's the spending less, which would be equivalent to earning more. So looking for ways, and perhaps it's not that $7 cup of coffee, but maybe there are other ways. Maybe it's trading off eating out, which might be more expensive than eating in. Or then the other alternative, coming back to the other lever, is being prepared to work longer. Maybe you had in your mind that you'd retire at 60, and maybe you should be thinking 65 or 67 or whatever the case might be. So something has to give. If you don't have those options, then you might have to readjust what your financial goals are going to be, because everything has to add up at the end of the day.
For sure, one way to up your income is to invest and take advantage of compounding. And generally, the bedrock of a portfolio would be stocks and bonds, with stocks being riskier than bonds. And then we have to deal with being our own worst enemy.
There are a lot of well-known emotional factors, biases that we as individuals have. I know I have them as well. And so we have to recognize them and try to overcome them. And So some examples, we often get really excited when we see an investment opportunity and we really look at it through rose-colored glasses and just assume everything is going to go perfectly great in terms of how we expect things to unfold. Another one is that we often confuse good companies and good investments. And I'll use an example without having any particular knowledge of whether this is true or not, but I do own a lot of Apple products. I love my iPhone and my iPad and my Mac. So I think Apple is a great company and they make great things. What I can't tell you today, Howie, is whether investing in Apple today is a good investment. Really, that comes down to what we think the true value of Apple stock should be versus what it's selling for now. So just because we see a great company, it doesn't necessarily mean that it's a great investment. And that goes for any stock as well. I'm not just singling out Apple. Other potential glitches, we're often overconfident in our own abilities to identify individual stocks where we think these stocks are going to outperform.
Oh man, what other things should investors look out for in terms of emotions and obstacles to successful investing?
Another one is FOMO, fear of missing out. And this is not a new phenomena. Certainly, it's become more heightened in terms of our social media world and the pressure we tend to get looking at how seemingly great others are doing and missing out on various opportunities. It also pertains to investing, but this goes back centuries to Sir Isaac Newton, and we know of him as a mathematician and a physicist, but he was also an investor. And back in 1720, he made some huge investments in a really hot stock at the time, which was the South Sea stock. And this was a stock that within a matter of months increased in value almost 10 times. And partway through this huge rally that it had for various reasons, he sold out. He made a lot of money. And after he sold out, he watched the price of the stock go up higher and higher. And he had regrets for selling out. So he got back in, and he got back in at probably the worst time. And the stock that had gone from 100 to 1,000 went back to 100, all within the span of 12 months. And this was an important lesson for him. And centuries later, we still have that feeling, have that bias. So those are some examples of things that could go wrong if we let our emotions take over.
Sounds like we still haven't learnt our lessons centuries later. Don't let your ability or inability to sleep at night or the strength of your stomach come into play.
Absolutely. That comes back to the three levers. To the extent that I've saved more, to the extent that I've invested for a longer period of time, then I don't have to worry about my stomach as much. I don't have to worry about taking on as much risk.
Steve Foerster, Professor of Finance, Ivey Business School. His latest book is Trailblazers, Heroes and Crooks, Stories to Make You a Smarter Investor. And don't forget to send us an email if you have feedback or an episode idea, btpodcasts@sph.com.sg. I'm Howie Lim, and this has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.